We are the Catholic Finance Association. My name's Jeff Smith. I'm the president of the Catholic Finance Association. And so that we can get back to the cocktails, I'm going to just jump right into it and introduce you to a really excellent fellow, our moderator for the night, who is also our executive director. You know, it's interesting with Catholic Finance Association. Executive director's got to be somebody who knows finance backwards and forwards, but also knows Catholic social teaching, and also cares enough about that and enough about his brothers and sisters to do it really as a labor of love. And there aren't so many of those folks around, but there is one person, and he has a name, and it's Blake Robinson, who comes to us most recently from Stelluck, which is a multifamily family office advisory service. Also has degrees from Carnegie Mellon and Princeton University, and so I give you our executive director, Blake Robinson.
Thank you very much, Jeff. It's my pleasure to introduce our panelists tonight who will be speaking on their 2014 outlooks with a special focus on issues related to Catholic social teaching. Our format tonight will be the following. Each panelist will make their comments about their 2014 outlook. We'll have a time for questions from myself and the other panelists within the panel, and then we'll open things up for questions from the audience. You may have noticed the note cards on the seats. For a question and answer session, we'd ask that you jot down your comment or question on the note card, and one of our volunteers, Maggie, will come and pick them up around the time that Jose Barrio Nuevo finishes his comments. Our first panelist is Jason Trennert. He is a managing partner and co-founder of Strategas Research Partners, a macro institutional research and advisory firm. He's been ranked consistently by Institutional Investor magazine as one of the top strategists on Wall Street, and he appears frequently on CNBC and Bloomberg Television. Our next panelist is Samuel Saladino. He's the CEO of Trinity Fiduciary Partners and a portfolio manager of the Epiphany Funds. He's also created the FFV Scorecard, which is a screening tool used by institutional investors to screen out companies that they find to have moral problems. Mr. Saladino has also appeared in media outlets, for example, in Time Magazine, Barron's, and the National Catholic Register. Our third panelist, Jose Barrio Nuevo, is the managing director of global capital markets at Storm Harbor, which is an independent global markets and financial advisory firm. Mr. Barrio Nuevo participated in the restructuring of Argentina's $104 billion in defaulted debt, which remains today as the largest sovereign debt restructuring in history. At this point, it's my pleasure to turn it over to Jason Trennert.
Great. Well, thank you. Thank you very much, Blake. Thank you, Jeff. I think we're each going to speak for about 10 minutes. Is that about right? So I won't try not to wear you out too much in terms of mumbo jumbo and all the kind of the buzzwords and all the rest of it. But I'll talk to you mainly just about my view of the markets. And I'm a big picture guy, so it's probably going to be the least reliable stuff that you hear this evening, but probably the most familiar of the things that you're talking about. I know there's a lot of hand-wringing and gnashing of teeth right now about whether the stock market's in a bubble. You're seeing quite a bit about that in the popular media. And I have to tell you my own view, and just trying to look at this dispassionately, and I can tell you I'm not selling anything. We're a research firm, so our only incentive is to be correct. There's no other incentive. We're not always correct, but that's our only incentive. My own view is that there's a lot of signs that would tell me that the market isn't in a bubble, stock market, right now. And that has largely to do with the fact that the central bank in my view, is largely going to continue on this path of what we would call financial repression for a long period of time. And financial repression is one way. If you can't create inflation, the next best thing is you do financial repression, which is you suppress rates to the point where you force people into riskier assets. And I know that's part of the reason why most of us don't feel good about the fact that the stock market's hitting new highs, right? Because there's a sense in which this is a little bit of a Potemkin village, something that's not really real. I think that there's an element of truth in that. By the same token, I think that it's also likely to continue for a long period of time. Earlier this year, I wrote a piece, and Alexandra Priet helped me get it published in a journal. It was called Stocks, the TINA asset class. And TINA stands for There Is No Alternative. And TINA, interestingly enough, that was a nickname that was given to Margaret Thatcher in the late 70s and early 80s. And it was because she so frequently said that to the Keynesians in Parliament about her liberalization with a small L of the British economy. So when she first came in, she said, we can't do this anymore. We can't continue to spend money we don't have. She also famously said, the problem with socialism is eventually you run out of other people's money. You might have seen that. And so she went to, she did sell like British Post, British Telecom, she did a lot of privatizations, all the rest of it. And the Keynesians would go crazy, and she would just simply say, there is no alternative. And she said it so frequently, they called her Tina as a nickname. And I kind of view stocks as basically the only real alternative for those looking to get returns above the rate of inflation for a long period of time. But the irony, I deal with mostly institutional investors, and I would say one of the great ironies about what's going on this year, and I wasn't in the office the last 3 or 4 days here, but the total return for the S&P 500 might be something like 28% year to date, which is, in other parts of my career, people would be high-fiving or line dancing or, 28% is about 28% is pretty out there in terms of what you can expect in any given year. And yet, no one's happy, I find. Very few people are really that excited about it. I think institutional investors, who are my clients, they're not that excited about it really for 3 reasons. One is that the index itself has been very hard to beat. So if you're an active manager, it's just a very hard bogey. So that's number one. Number two, people think that it's artificial, which is to say that it's completely driven by Fed policy and not by real economic data. And I think that's only partially true. I think it's fully true. And the third thing is that there's a sense in which, and I believe this, that a lot of the government policies that are being pursued, fiscal and monetary policies, are actually having the unintended consequence of, I think a lot of them were designed initially to actually shrink the difference between rich and poor. And I would argue in many ways the monetary policies right now are actually exacerbating the differences between rich and poor. Just the extent to which, if you're somewhat wealthy, you're getting hit with higher taxes. There's no two ways about that. And there's a little bit of a last flight out of Saigon element of New York City right now. At least that's the way I feel. But we'll see how that works out with Mr. de Blasio. But on the other hand, your stocks are going up, your house prices are going up, and all the rest of it. So I think those are the 3 reasons why that people don't feel good about it. The one thing I would say about thinking about it as a bubble is that everything has to be priced off of something else. And right now, interest rates are, obviously very, very low. Even if the Fed were out of the way, my own view is that interest rates would be very low. And equities are providing you probably the best alternative, even at these valuations, to get returns in excess of the rate of inflation. Interestingly enough, and this might be too esoteric, but there's an awful lot of companies that are actually sporting credit default swap spreads that are lower than that of a lot of sovereign debt, which means that the market is saying that a lot of companies in the U.S. actually are better credit risks than, let's say, French sovereign debt, or there's 15 companies that actually have better insurance rates against default than U.S. sovereign debt. And so it's kind of remarkable how bad things have been in terms of the profligacy of a lot of sovereigns. As far as the Fed is concerned, I just want to say one or two things about that, and then I'll get into the Affordable Care Act, and then I'll get out of here, then I'll turn it over to my friend. We obviously are going to have a new Fed chairperson, chairman, in the form of Janet Yellen. And I think it's very interesting it'll be very interesting to kind of take a look at obviously how she handles things. I will say that while Ben Bernanke and Janet Yellen have often come to the same conclusions about monetary policy, they're coming at them from very different points of view, which is to say that their academic work is really in two different spheres. Ben Bernanke's, all of his academic work was really on the mistakes that the Fed made during the Great Depression. In particular, the Fed was actually quite tight during the Great Depression in terms of monetary policy. And so he views everything through that lens, and he's basically come to the conclusion that if you have a choice between inflation and deflation as a central banker, you always want to err on the side of creating too much inflation. And what you have now is you have a lot of people singing from the same hymnal among central bankers around the world. Janet Yellen's academic work is focused a lot on the labor markets, on the relationship between monetary policy and getting unemployment rate down. And now, I'll tell you, my own view is that monetary policy is a very blunt instrument, and it's a very imperfect way to get. The problem with liquidity is it's a very powerful instrument, but it's very hard to have it be targeted. So, but her view is basically that you can use monetary policy to achieve certain goals in terms of unemployment. My view is it's a little bit like using a shovel to hammer in a nail. You know, it'll work, but there could be a lot of collateral damage, or there could be a lot of things that happen that you don't want to have happen. But in terms of looking at 2014, I think it's safe to say the returns will be less than you're going to have this year. I think it's going to be very hard to have the multiple expansion that you have, and that's mainly because the Fed isn't going to be as munificent as it was this year. By the same token, I think in many ways the U.S. Is likely to continue to be one of the best economies in the world, one of the strongest economies in the world. And so, and I don't think that the valuations are really all that out of bounds with regard to where interest rates are and other asset classes. The last thing I'm going to mention, and I'm getting the kind of the hit and run sign here to start moving on. But the other thing I would mention, I know it's all the rage right now, is the Affordable Care Act, or Obamacare. And I've spent some time on this. We have a Washington office. And to me, I have to say, as just someone who's, who followed this from the beginning and was against it from the beginning, the biggest lie, if you want to use that word, I know that's probably a strong word in some quarters. The biggest lie that was told to me is not that you could keep your coverage if you wanted it. Because the biggest lie to me was the idea that the Affordable Care Act would be budget neutral, deficit neutral. I don't know if you heard that a lot when it was being pitched. But, and the reason why I'll say that is that it really flies in the face of history. When Medicare was projected, I'll just give you a quick, just rundown of the government's ability to forecast healthcare costs. But when LBJ came up with the Great Society, and when he came up with Medicare, he projected, or the best and the brightest projected, that Medicare would cost $9 billion in 1990. They made a 25-year projection of what it would cost. And in 1990, it actually cost $98 billion. Okay, so, which is a pretty big whiff, in terms of just, and ultimately, there was a guy in the Johnson administration, I'll end with this, Joe Califano, and they asked him on Charlie Rose, said, gee, that's a pretty big miss. How did you guys get it so wrong? And he said, well, there's two things we got wrong. First thing we got wrong was inflation was higher than we thought. And the second thing we got wrong is that you can't imagine Medicare coverage or medical coverage as being static. You imagined it as being static, but it's not static. So you have innovation, you have all these other things that are wonderful that keep people alive a lot longer, but that creates other costs. And that's why I felt very strongly when it was being proposed that it was a fool's errand in many ways to think that it would be. And we could argue whether it's a good thing or a bad thing to have universal coverage or all the rest of it. The only thing I'll say is you just have to pay for it. Right? That's the only thing as an economist is that you can have any society you want. You just have to, eventually you have to be able to pay for it. And with that, I'm going to end. I probably went on too long, but that's what I got. Anyway.
Well, my name is Sam Saladino, and as you can tell from my accent, I'm from New York. No, I'm from Texas. My career has been 8 years ago. I started focusing on Catholic investing, and that's all that our firm does. We do Catholic investing, and that's it. So one of the things I want to say before I get started is I think it's great that all of you are here. 8 years ago, when we started talking about Catholic investing, we would have events like this and no one would show up. Bunch of crickets. So as a funny thing to start with, because you got to have a funny story, I was actually asked about 3 years ago, I was asked to be on MSNBC, and I thought, man, I made it. I'm going to be on MSNBC. It's going to be the greatest thing ever. So I tell my kids, let's watch Dad on MSNBC. Catholic investing hits the big time. And so I'm there, I'm doing the interview, and I finished the interview, live television. I've got the green screen. I have no idea what they're doing. And my daughter calls me, and she's just laughing. And I said, well, what's so funny about what I said? I was talking about the economy and the market. She said, well, while you were doing it, they put a halo and wings on your back. And I said, Catholic investing made it, because I was an angel for one day. So I want to talk about, I'll talk about our economic forecast a bit, but I want to give you kind of a perspective to what we think about when we think about things from a Catholic investing perspective. First of all of you may know this, but the document that sort of controls Catholic investing in the market is the USCCB document on SRI investing. And that document was written in 2003. If you have not read it, that would be a good place to start. It's kind of the baseline that everybody looks at. 14 pages, light reading, puts you to bed about 3 nights in a row before you'll get through it. But you'll get there. That document was written in 2003. I'm going to say that again. One of the things we've been talking to the bishops about is rewriting that document, because I don't know about you guys, but the world's changed a little bit since 2003. The internet, wasn't quite the same then, and the products and the technology and all of these things. So what we've done is we've taken a group of people, they're Catholic leaders, thought leaders, some of them work with the poor, some of them work with the rich, some of them work all between, and we've kind of tried to interpret that document and build a scoring system for companies. And it's not just about the exclusions, it's not just about the abortifacients and the abortion. It's important to exclude those things, but it's actually about what makes a company good, what makes a company better for the world. And do you think that a company that's better for the world will have more growth? I believe it will. But that's sort of the premise of all of this. So there are documents, there are catechism documents, there are social encyclicals that talk about investing. This is not a new concept, new sort of adoption, not a new concept. This has roots in 16th century English trust law. People were saying you shouldn't invest in this and that and this to protect their kids from making mistakes. That's what they were interested in. And that sort of developed. Unfortunately, in our country in the 70s, it took a TIVA-style momentum and change, and it got to be kind of a green movement. And when that happened, some of the original intentions got lost. But now those are being married back in, and you have environmental and faith-based investing that are both working together. So when I think of the economy next year, unfortunately, we run funds. We do sell something. Epiphany Funds, look it up. We do sell something. So we run funds. We have to run a growth fund, whether the market is down 50% or up 50%, we're still buying stocks because we have to do that. We run a growth fund. We can only hold, by rule, 5% in cash. So, we're buying stocks. That's what we do. But what I will tell you is if you look at it from what investors are doing, and people always say investors are incorrect, they love our equity funds right now. They think we're really smart. The market's up. I will say this, the index has been a challenge and has been making us upset. But we are ahead of the index right now for the year with less risk over a 3-year period. We have one fund that has a 5-year track record. I think that the market multiples of the stocks that we are holding are still in fair ranges, but they are higher than they were a year ago, and that concerns me. I can't, when I would do when I would do the fundamental part of my work, I would have lots of stocks to choose from a year ago. Right now, I have 20, and it's hard. It makes it for a difficult work because we are scoring them economically and also the social as well. So here's a couple of things that I would say long-term for the economy should concern us as Catholics and sort of inform our investment decisions. One of them is the population and demographic change. This is sort of went under the radar, but now it's become so big people can't really ignore it anymore. The bottom line is developed countries are not having children at the rate of other countries, and it has gotten to be the gap. We got a window open. Someone's jumping out already. It's not that bad. It's not that bad. If you jump out, that'll be one less, bigger problem. Well, you can't do that. So the point is that from a simple economic standpoint, people buy things, right? And when they buy things, that makes companies have a chance of profit. You need people to buy things, and you need more people to buy more things so you can grow. It is difficult to grow. There's only so many efficiencies that you can get by just a better product cycle. You have to sell stuff in this world. And so one of the things I would say to you about population is the effect of abortion in this country and the effect of contraception in this country is a lot bigger than people think. And it kind of snuck up on people, but now it's sort of there. The birth rate for a woman today is 1.4. That's not replacing the other person, right? That's kind of a problem because we should at least be replacing ourselves. At the same time, you have countries where it's above 6. So it's a really interesting topic because normally when the population rate of this country is shown on television, immigration is included. So you don't really get a true picture for the people of the country. So all of you fine folks here, as Jeff has pointed out, people in New York are savvy. All of you fine savvy people, all of your children are going to be hopefully savvy people. They'll grow up, they'll buy things, they'll be good members of society. Other people that are coming into our economy by immigration, they might be that way, they might not. Who knows? It's just a difference. So what I would say about the economy and population and the population growth is, where is the population growth? It's basically in 3 major regions. It's in Latin America to a lesser extent. It's in Asia and in Africa. So one of the things that we did is, when you only have 4 mutual funds, you'd think you wouldn't have a specialty fund. We have a Latin American fund. So we believe that the Latin American population is going to increase. We believe the economy is better and that these funds will grow. So we're big fans of Latin America at our shop. So, and when you look at population, my thought is this. Right now, Spain has a population of 48 million people. That sounds pretty good. What's going to be the amount of people in Spain in 2050 projected right now? 46 million. The weird part about it is that if you look at the demographic shift, oh my gosh, I'm already only 1 minute out. I like to talk. The weird part about it is the demographics are shifting so much that the population also has aged. So I would say having companies that don't invest in abortion or don't make an aborted patient or a contraceptive product is good for all of us, and it's a Catholic thought. Let me get to my last one real quick because we only have 30 seconds. Compensation in the workplace. Compensation in the workplace, sometimes people think of this sort of as socialism. It's not. There is something called a living wage, you should know, and it's what a person needs to live when they work at a job. And by Catholic teaching, that's what we should do. If people work at a job, they should be able to live. Pretty simple. Free, virtuous, be able to praise God, all of those pieces. The problem is a lot of times people say a company high in population, in wages, will also be not very good with profit. Well, I just want to give you an example to kind of whet this topic. Walmart pays, in any market they open, they pay under the living wage. And sometimes they even have to petition to be able to do it. In fact, when they open a Walmart, you have to add about $1 million a year in social services for the people that work at Walmart. So you can help them. Because the biggest group of people being served by Catholic Charities today are working people. They have jobs, and they're over there getting help because they can't afford it. Walmart has averaged 6% rate of return for the last 15 years. That's 2% under discount retailers, which is where they are. So they haven't beat the discount retailers. Costco, on the other hand, has wages that are 50% higher than Walmart. And that doesn't happen. The problem with social services doesn't happen when they open a Costco. Anyone want to take a stab at how low Costco's return has been in the last 15 years? It's been 10%. So Walmart has had a 4% annual return less than Costco and paid their workers 50% less. So the thought I would give is that it always isn't on the back of the worker to make a company profitable. And I'm done, or they're going to shoot me.
Thank you. Thanks. My name is Jose Barrio Nuevo, and what I'd like to do is, talk to you a little bit about 2014 from a context that is perhaps, a little more global, but that certainly highlights the key drivers for the performance of the U.S. economy, which I think are obviously very critical for everyone, and there's not going to be any difference next year. The Federal Reserve, of course, their policies are going to be the most important driver, I think, except that early in the year, I would say that one thing that we are not neglecting, but we don't seem to find, a way to deal with is the political crisis that we have in Washington. And I think that that's really important because, we have to go back to the U.S. financial crisis to understand that. And that is because, the U.S. financial crisis was so severe that there's only been other two that are kind of similar to that. One happened in 1907, and the other one, as you know, in 1934. And the main difference between those three is that in the first two, you had very, very strong leaders. And that's very important. Because when you have a crisis, you need to assign the cost of whatever went wrong. And if you don't assign the cost, things are going to get worse. And that's obviously what we're seeing right now. Of those three crises, in the first two, we have obviously the two Roosevelts, which obviously dealt with those crises in extremely not just skillful manner, but in a way that no one probably could ever imagine, and in which they always chose the American people first, and that's very, very important. In the most recent crisis, I think because of the lack of experience, we didn't have that leadership, and that's what really stands out. And not having that leadership means that those costs were not assigned. You just kind of push everything to later, postpone everything. And one thing that you learn when you have a financial crisis is that, the most important thing you have to figure out is what is the value of the assets that were compromised. And that's interesting because the only one question that no one asked during the crisis is, how bad it was. What is the size of the balance sheet that was compromised? It's very simple. Worked in a lot of emerging market crises, and we knew in Mexico, for example, in '95, that the country was going to go down the drain because it couldn't come up with $30 billion to repay their Tesobonos debt. And in 2001, Argentina obviously defaulted. It took us about a year to figure out that they owed, about $104 billion. But in the case of the U.S. crisis, the main issue we know was not just really the mortgage and the mortgages that were compromised, but all the securities and derivatives that were built based on those, and in which obviously the main problem was the abuse of leverage. And at the end, that is really a critical thing, because one aspect that keeps being neglected all the time, we always talk about, some people talk about the normal, the new normal. There's nothing normal, there's nothing new here. What is going on is simply that we had such a level of assets compromised, in a way that we never seen before, that the only possible way that you could, get out of it, gradually over time, was obviously by letting the major institutions delever on their own. And that's basically what the Federal Reserve chose. And there was obviously also some institutions that were intervened, that were restructured. There was a lot of deleveraging that actually took place during the crisis. That's why it was so bad. But there was a lot more that had to continue, and that's the main reason why the economy doesn't grow, because we still have that process of dealing with, rebuilding the balance sheets of a lot of these financial institutions. And that's the main reason. That's the main reason we don't have a lot of growth. And obviously, we can see it right away. This is the weakest growth for any recovery in, post-World War II U.S. history by a long shot. And at the same time, you have also one of the best stock markets and financial market performance, which obviously has to do with the fact that rates have been very, very low. But I think that at the end of the day, at one point, the stock market is going to catch up with reality, and that reality is going to be that you're not growing that much. And it's going to change. And when that deleveraging is over, we're going to see credit expanding very fast. We're going to see investment, private investment recovering, and that's when employment is going to recover as well. Okay? So there's really nothing abnormal of what we're living through. It's just simply that we don't have the leadership, and obviously there's been no effort to assign the cost. And when you don't do that, the cost is disproportionately assigned amongst the ones that can, obviously, or have the least ability to kind of defend themselves. And that happens, obviously, in every emerging market crisis. And that's why one thing that you always see in emerging markets is this huge income discrepancy. The income distribution is appalling. Very few people, literally sometimes hundreds, run the place, and millions of people live with $1 or $2 a day, which obviously means that they live under extreme poverty. Now, this is interesting because this never happened before in the US. When you had a financial crisis, you had people that would deal with them, even in ways that, of course, the financial players were not very happy with. I'm sure you all know that FDR and Teddy Roosevelt were very deeply hated by the financial, institutions at the time. But they did the right thing. They obviously stood up for the people, and of course, the crises were very difficult. It took a while to resolve them, but it was over a basis that was fair. And that is kind of the problem that you have now, and the reason why you have this huge split in the political establishment that reflects that extreme discrepancies that are taking place, and that dynamic. And that is, I think, in my view, the worst thing that is happening to the U.S., because the U.S. has always been and remains and will continue to be the best story in the world. I'm not saying that it's going to change a lot, mainly because everybody else is in a lot worse position, not because this is great. But at the end of the day, this is very relevant because that is what gave the economy its dynamism, its ability to resolve crises very quickly. Of course, the people that are in these interest groups, they don't want to pay for it. You always have that. That's nothing different anywhere in the world. But the leadership, again, is the main difference. So why do I tell you all of this? Because, at the end of the day, we have these kind of efforts, pushing markets around. Obviously, it's not just the low interest rates, but it's this kind of sense of different interest groups kind of reasserting themselves on the economy. And at the end of the day, one of the most significant things about what the Fed is doing, and I actually have a very positive view of the Fed, thank God that Bernanke was where he was, and thank God that he moved as quickly as he did, because otherwise we wouldn't really have a problem economy today. It would be really, really bad. So I think the Fed actually is the top performers by a long shot. Obviously, they have very few tools that are dealing with many things, including, in a way, some political things that, of course, they are not supposed to be dealing with anyways. So in that sense, I would say that the main thing that I look forward, into 2014 is that, the political crisis in January is going to be very, very important. I think you have these, again, extreme positions in which I think it's going to, at some point, it's going to come to, it has to get significantly worse for people, unfortunately, or the current political players to move into a responsible political position. I think it's going to be very difficult for either side to abandon, their positions, which again are very extreme. I happen to think that this time around, the idea on the Republican side that you do need to have a long-term, fiscal program that obviously ensures that, you make this growth and this economy sustainable again is obviously the only way to go. I think it's really important. And unfortunately, I don't think that the administration really shares that. And I think, in fact, it actually thinks that public spending should be even higher, despite the evidence that, the stronger public spending has done nothing for growth. And again, it's because of this financial deleveraging. One thing that is interesting, if you look at the stock market, I think it's overvalued at least 25%. And the reason why I say that is because every time it rallied in the last couple of years, it was on new announcements of expansions of the liquidity program. There was even more to come. This time around, the expansion, although it seems that no one really paid attention to it, is taking place despite the fact that nothing is expanding anymore. What the Fed is just saying is we're not going to be removing that liquidity very quickly, but that will be obviously restraining, and that in that sense, the liquidity is going to be moving out, not in. And the most significant thing is that the Fed is not very comfortable with the growth picture. It's not very comfortable yet with the employment picture. But the biggest issue they have is obviously dealing with such a large balance sheet, which is going to be complicating how they manage monetary policy later on. So it's not even the economy that is leading them to talk about this idea of tapering. It's really more the complications that it adds, the fact that the very simple thing at the end of the day is you grow such a large balance sheet and you end up, acquiring a lot of these securities that were compromised and they're in their balance sheet, and you start taking losses, then it becomes a huge political problem because at the end the Fed is not it's not the Treasury. The Treasury is the one that is responsible to pay for these things. If they don't pay for them, that's when you have inflation. So the concern here is, the lack of leadership. I just add very quickly in the case of Europe and the rest of the world is the same thing. Germany will need to decide if they want to really help the southern periphery countries. If they don't, the euro is not going to last, because at the end of the day, unlike the US, they have done nothing whatsoever on deleveraging. So I expect the euro to be a little bit stronger early in the year when there are pressures on the US and growth, but very weak in the second half of the year. And with that, I'll finish. Thanks.
Thank you very much. To start us off, I'd just like to ask Jason Trennert to react to some comments that Sam Saladino made about the impact of population growth or lack thereof on our economic outlook both next year and in future years.
Great. Thank you, Blake. Yeah, I thought what Sam said was very interesting, and I think he's right. I think that there's still what you almost call a Malthusian view of the world, which is that more people are bad, and you might remember from the movie Wall Street, there's certain, I'll probably be careful saying this in the Union Club, but at a certain point he's in the, Gordon Gekko's in the steam room, and he says, it's the thing about wasps, kid, they love animals, but they hate people, I don't know if you remember that. And I think that there's an element of that a little bit in that people, was my own particular view, people are much more worried about the planet than they were worried about just human beings. And human beings are, if you're looking from an economic point of view, GDP growth is essentially population growth plus productivity. That's real GDP growth. That's axiomatic. That's how you define it. And more people are good. One of the things that you found, certainly with agriculture and what you found with oil, actually, is that despite all of the, again, wringing of hands and gnashing of teeth about how you're going to run out of resources, what you found is that productivity is the great equalizer in those things. So when you see payroll employment every month, they actually quote it, if you look carefully, they quote it as non-farm payroll, which is, it's really an anachronism, because in the old days, there were a lot of people involved in farming, and that they had to actually break out the data between non-farm and farm payroll. And now, of course, that's the number of people involved in farming in this country is very, very low. And I'm not making a value judgment on that, but it's just, life has moved on. In any event, I think China actually recently talked about abandoning, to a certain extent, its one-child policy. And I viewed that as an extraordinarily positive, not only just morally positive, which I think almost goes without saying, as anyone, as a Catholic, but also just as a human being, that's very positive. But it's also economically, potentially very positive, obviously. So, in any event, that's the kind of way I'm looking at it.
Would you like to respond to that, Sam, or?
You said it all.
Sure. Very good.
Can I just one thing?
Sure.
It's actually just for growth is productivity, but then and then population growth, which population growth tends to be relatively small usually. The most significant one of all is productivity, and the other one that we need to highlight is investment as a share of GDP. That's really the main one, and that's the one that gives you the business cycles. Private investment, that is.
Jose, you and Jason Trenner both commented that the financial crisis has caused some large wealth disparities between rich and poor. I think, Jason, you mentioned it in the context of some of the Fed policies, and Jose, you mentioned it in the case of what can happen in a debt crisis. I wanted to ask you, you mentioned that the Fed did a lot for positive during the financial crisis, whereas Jason mentioned that some of their policies exacerbated the differences between rich and poor. Would you care to comment on how you feel that the Fed has or has not contributed to these disparities?
Sure. Yeah, actually, what the Fed did is basically, provided the liquidity to make sure that large corporations, large financial institutions, didn't go bankrupt, and the ripple effect on the economy, obviously, of that would be devastating. You will have a huge credit contraction, which obviously means you go not only into a recession but potentially into a depression. So that's the main reason why they provide so much liquidity. The other thing about the low interest rates is that when you do restructurings and you're worried about assets being compromised and you need to delever, the United States is in a unique position because it's the only country in the world that can deal with that deleveraging in a market-driven way, meaning you can set the interest rate as low as possible for a very long period of time. So the best thing that the Fed can do to accelerate the deleveraging, that's a positive contribution, obviously, is to try to affect long-term rates, have them as low as they possibly can, which is really what Bernanke was trying to do with the QE. He failed for other reasons. The main reason I think he failed in a way. I think he was successful to some extent, but it's a very difficult, obviously, situation. But the reason why he failed is because he was not prepared to go against some of the major investment funds, against the banks, obviously, that they would like to have their cake and eat it too. Obviously, they are arbitrating this spread. You're getting funded at zero, and then you invest in treasuries. You want to have that spread to be as wide as possible. For the Fed, obviously, the ideal is that it's as narrow as possible so that you can restructure all these securities into very long term. Just send it out there. And that is what is going to start giving you more traction in the short term and getting credit to move. This is an economy that to grow is heavily dependent on credit and therefore on private investment. Until we don't have those two, we're not going to grow very much. That's why I think the contribution was actually very positive.
Any reaction to that, Jason?
Well, it's not really a direct comment relating to those comments, but I think in my case, I look at it a little bit differently. I think that my concern is really with the changing demographic in the U.S. and most of those people being retired, and what's happened to those retired persons' portfolios as a result of these actions. There were years ago where people would retire, put it in CDs or bonds or an annuity and get their income, and everything was great, and they were living in a great way. That's really not possible now. So you have a lot of people that have a retirement nest egg that maybe they'll never earn another dollar in their life that are, I was talking to an advisor the other day, we have an income fund, and he was telling me his retirement clients, he's putting 80% of them and 80% of their portfolio on our equity funds because he's trying to generate return so that they can live and do their thing. That's a concern. But I understand why he's doing it. He's trying to generate enough income so that they can keep moving. And that is sort of, I think, is an unintended consequence of these actions to the general investing public. My concern is if there is a pullback and the market does fall, what happens to those people? Because in general, they will sell when they lose 20%, and they are never getting it back. That's it. And I think, you know, I don't really know from a big economic picture the effect, but I think as far as the American public, it's a concern.
Well, I just want to comment on a couple of things. Actually, you know, from at least the way I'm looking at the data, remarkably, retail investors really have not been big participants in this rally. If you look at mutual fund flows, you've seen $550 billion worth of redemptions from equity market mutual funds from 2008 to 2012, and you've seen $1 trillion go into equity, into bond funds. And so this is one of the reasons why I think the market actually could continue to move higher. It's just that, to be honest, I'm not sure the kind of the last guys in are in yet, and that's usually what kind of precipitates the end. As far as what it's usually the way it works, unfortunately, and I don't want to be flip about it, but it's usually the, let's put it kindly, the less sophisticated investor really is the most enthusiastic at the top. And right now, the less sophisticated investors are really more worried about volatility. And what worries me is they're using bonds as a proxy for cash, which is very dangerous. And you saw how that didn't work out particularly well earlier this summer. The only thing, just going back to what the Fed is doing, and I tend to agree a lot with the idea that I think the Fed did a very good job in many ways in counteracting the contraction of credit. The only problem I have with, the biggest problem I have with what they're doing right now is that in many ways they're providing such a big fig leaf for other policymakers to do the right thing that no one feels the pressure or the urgency, particularly the administration or Congress, to do anything good to get economic growth going, because you have an enormous Bernanke put, and so Bill Clinton was scared senseless of the bond market. Here this year, the Fed's bought about 75% of the net new issuance of Treasuries. There's no sense of urgency to do anything to create capital or to do something on the supply side. And to me, that's the problem, and that's part of the reason why the economic activity is likely to remain low. So, Mae West said too much of a good thing is terrific, and I think she's wrong in this case. I think too much of a good thing is actually being harmful to economic growth.
Thank you. Now I'll start going through some of the questions from you all. This one is for Sam Saladino. Does your firm believe or practice divestment as I believe it says, doctrinal social tool?
The answer to that is that we we don't. We, if I understand the question, that we, in the way that we look at our investment for Catholic social justice teaching, we're trying our best to look for investments that, first of all, don't violate any social justice teaching. So there's not exclusions that would apply. The abortifacients, contraception, things like in that area. But then where the scorecard really comes alive in the scoring and the FFV scorecard is scoring a company based on their policies and on their performance of those policies. The next step of that, which is probably more leads into the question, but the next step of that is company conversations, which are starting to happen now. We're just now getting big enough to have that and to explain to them what would actually make a difference. And they're starting to get more eager to do those, to have those conversations with us, but that's sort of the next piece to come.
This next question has to do with the real estate markets. Will the Obama and de Blasio administration put a needle to the real estate bubble in New York City? What can we expect in the next 4 years? I'm not sure if this is anyone's area of expertise in particular, but perhaps we can talk not just about the real estate market in New York, but broader areas.
I'll just do a quick one. New York, I think, is a very, it's a very unique real estate market, and the U.S. is very unique too because it's a reserve currency and reserve country. So, frankly, you can get away with a lot of bad habits more than you can in other countries. And I think, thankfully, it would take a lot to really prick the bubble of the New York City real estate market. And that's mainly because I think for a lot of people around the world, they view New York City real estate as a store of wealth. And I think that actually you saw that, particularly after Cyprus. I don't know if you remember, it seems like ancient history, but Cyprus actually put a haircut on, took a haircut off of bank deposits earlier in the year because they got themselves into so much trouble. And so after that, you've actually seen very high-end real estate in New York actually move up even higher. And I think it's mainly because people say, it's harder to steal a New York City New York City condo than it is my Cyprus bank account. So now, it doesn't mean that it's a divine right. Doesn't mean it lasts forever. But I'm not so sure. I don't think we're at imminent risk. As far as Mr. de Blasio is concerned, I think security, my own view as somebody that lives here with a family, I think security is kind of the big issue. Mm-hmm. Taxes, people might be able to deal with that, but security weakens that people feel less safe. That's a different story.
Mm-hmm. This will be our last question for Jose Barrio Nuevo. What sectors of the economy or geographic areas do you think are the healthiest at this point?
I think emerging economies, and there are, some of them, like I would say right now, Mexico is really trying to push to get foreign capital moving, strongly into the country. I think that's a good story. There are a number of them in Latin America. I would say Mexico, Colombia is another one that has made a lot of progress. Chile has been for a long time. And Brazil has gone through a rough period, but I think it's going to start improving as well. So I agree with the view that Latin America, to the extent that it continues to do some reforms, it will be attracting capital. I think one of the points before on this issue about low interest rate, low returns in the U.S., that's just a consequence on dealing with the crisis and obviously trying to facilitate the deleveraging. By definition, if you're deleveraging, it's because you had a bubble, you're not going to have a lot of investment here for a while. So what you're supposed to do, and obviously that's what you do, is look for investments in other regions and places that have the higher return, and that's how people deal with the low returns here. But I would say definitely Latin America would put on top. I think China would probably be under some more pressure to start opening up a little bit more rapidly. But if they do slow down, as most people expect to, 7%, 6.5% growth next year, I think they're going to be under a lot of pressure because then, the social pressures become much more significant, and then you start having some political instability, and that's the one thing you don't want to see, obviously, in the world.
Thank you very much, Jose, and I'd like to ask for a round of applause for all our panelists. Jeff will be up in just 1 second.
Thank you so much. I want to thank our moderator and our panelists so much. We have the luxury of getting to talk to the panelists for weeks and months ahead of time, and we get to see these panels come together, and it can be an awfully fun thing, and I'm looking forward to going back and hearing. We've got audio on this, which we'll have on our website, which at the moment is cathfin, cathfin.com, but very soon we're having a launch of a new site, which will be catholicfinanceassociation.com, which will be a lot easier to find, we found out, than CathFin, even though it's shorter. So I guess people can type just fine. So I want to thank our moderator and our panelists. I also want to thank all the folks who made tonight possible. One group of whom is our sponsors, and we've had a number of great sponsors for this event. Proxy Mosaic has been sponsoring us this year, and they're fantastic. They are a wealth advisory fund where your values can go into your wealth advisor. You know, if you've got 100 or 500 or 1,000 stocks that you're trying to track the stockholder resolutions on, that's pretty impossible, and so most people just punt on that and just say whatever needs to be done, or they'll go to a couple of different wealth advisory services. But if you're a person of faith, you have a little difficulty in that, and so person of faith, or you've got particular views on wealth advisory, on shareholder advisory, then one of the only places you can go to, pretty much the only place you can go to, is Proxy Mosaic. And is Nathan here still? He was here, and he's probably going to be in the back later, so I would encourage you to talk to him. Also, Buckley Peterson, which is a leader in security, in due diligence, in cybersecurity especially, and they are a new sponsor, and we're very excited to them. It's interesting, you know, if you're Citibank, you're probably fairly set with cybersecurity. You've got a big staff, and you can be above that. But if you've got a hedge fund, you probably don't have the amount of staff, and so you don't have nearly as much money. But you're a lot easier to get into, and so cybersecurity in the finance world is a big growing concern. And Buckley Peterson is working on that, and then also the Epiphany Funds, which is a Catholic SRI fund. And you know, it's interesting that a lot of the Catholic SRI funds are simply negative filters, but the Epiphany Fund also has positive filters, working with companies that are doing good practice, not just simply filtering out companies doing bad practices, but working with companies that do good practices, and that's the Epiphany Funds. And Michael Sullivan, who is here and is not here at the moment to wave to you, but he'll be in the back, is a great guy to talk to about that. The other group that makes this possible is our members, and we're happy to say that whenever we get the word out that we've got an event going on, the first people that sign up is all of our great members, and we're very happy to have them. The membership is $250 a year, and it gives you the events for free, and it also gives you membership-only events, and then some events we only advertise to members, some events we mostly advertise to members, and it's you have to ask your tax advisor on this, but it's ostensibly it's tax deductible. So when you work it all together with the events that are then free for members and the tax deduction, it ends up being quite a cheaper way to go. And now the most important announcement is that the bar is open, and so I hope to see you in the back. If you'd like to become a member, we'll have a membership sign up in the back. If you would like to talk about sponsorship, talk to me. And again, a final round of applause for our moderator and our great panelists. And thank you, and have a great night.